Hello and welcome to this ET Now special, and today I have with me a very special guest here in India. I have with me Sean Darby, the Chief Global Equity Strategist at Jefferies, joining in the show right now. Sean, hi, good afternoon. Good to have you on the show. How's New Delhi's heat treating you?
Very well, thank you, and good afternoon as well.
Okay. I was wondering if you're comfortable in the New Delhi heat. I understand that there is an orange alert and the heat waves on in full scale.
Well, I have felt some of the temperature because I went outside of Delhi to visit Agra Fort on Sunday, so I'm well aware of the 40+ temperatures. Certainly very uncomfortable around noon. But I believe we're coming into monsoon season, so of course we've only have this period left for a few more weeks.
Yeah, we do. Okay, just wondering, when's the heat going to get off from equity markets? I mean, I was just looking at the equity outflows from India. They're the highest ever that we have seen since the 2000 crash. Is there merit to believe that we may be at the end of fear and perhaps greed is going to come back on the street anytime soon, or am I way off the mark here, Sean?
Well, I think two or three things are occurring at the same time. One is we've had US Treasury yields going above 10-year, going above 3%, and that's been a pretty sensitive level for the SPX and also for most global equity markets. I think secondly, the pace of rate tightening by the RBI has probably confirmed that there's not going to be any complacency from their point of view, and hence bond markets in India, of course, are just trying to find the level at which the RBI is going to be comfortable with. I think the third thing from my side is that there has been quite a lot of speculative capital going to EM markets overall. Remember, most of EM were running some of their lowest, if not historical lows of interest rate policies, and that in itself, I think, has meant that there's been a big catch-up phase for EM central banks, and India's no different in that respect. So to some extent, the sort of golden window for EM flows, which were essentially based on very, very low rates, continuing in India and elsewhere, has been by and largely now been reversed over the last couple of months.
But tell me, what would be the impact of inflation rates, quantitative tightening for PE multiples for markets across the globe and India in particular?
Well, it's a very good question. Really, the PE multiple is affected by two variables. The one that is most prominent, of course, is the long-term yield, because equities are long-duration assets. So in a way, equities have to compete with bonds, and the way they do that is really through the earnings yield versus the government bond yield. I think the second thing that's happening, and this is more pertinent for developed and other EM markets, is that company costs are moving up quite considerably. So you're getting this sort of slowdown in the top line sales revenue just as costs are moving up, and that doesn't bode well for margins. So the PE multiple is also affected by the margins of companies, so you're getting a double whammy at the moment. So certainly from both a micro and a bond market view, multiples will have to sort of derate in that type of environment.
But tell me, Sean, I mean, I don't know when we're going to go back to those pre-Russia-Ukraine levels on crude of 60, 70 odd. Your guess is as good as mine. The fact that we're still very much at 120 and the war is nowhere over, at least as of now, are markets pricing in high inflation for a very long duration?
Well, I think initially people thought that the inflation rate was, of course, just supply chain linked. Then it became much more due to overall commodity prices, including energy, not just metals and food prices. But there's a growing awareness now that wage growth is also starting to produce its own inflation dynamics. And I think that's the one where central banks are most sensitive to, because that one they can certainly control in their economy rather than the other two earlier points. And that's why, as I said, you're getting this tightening bias. So wages for the big large cap companies in India have been rising at a double-digit rate, and that tends to mean, of course, that you'll get some form of overheating in the domestic economy with maybe a 6 to 9 month lag.
So what are we staring at? I mean, are we going to continue to see outflows, FII outflows that is, out of India equities?
Well, I think in fairness, India's not the only one that's been experiencing outflows. There's been a temperature change in general for emerging markets, and I would say probably India's been the last in the whole train of countries seeing the outflows. I think the point to highlight is that we are going to get to some form of neutral policy quite quickly in the United States. Maybe over the next 12 months, rates will, in the short end, start to peak out. And that by and largely signals that most of the pressure on emerging markets will also recede. So I think the fact that you've got the Fed now actually tightening policy as well, and particularly when we look at the next week's FOMC, that will actually help a lot of the EM markets in mitigating some of the worst potential over tightening that might need to happen to curb some of the inflation pressures.
Interesting. So just because India has been the last one to hop on to the FII outflow train, does it mean mean that we still have further downside to go for equities at an index level?
I guess the way to approach it is that really having an eye on the government bond yield here will give you a better indication. So clearly we've seen in the United States, for example, that the yield curve over the last 2 months did invert very modestly and for a very short period of time. And that at least gave the equity market a signal that they perhaps don't want to be too late now in selling equities, because the bond market's already beginning in the United States to think that the Fed will have done a lot of tightening in the next 12 months. So the best way to answer that for India is very much the same, is that no central bank wants to see a flattening of the yield curve, because it generally bodes that you're doing quite a lot of the tightening already. And in that respect, I think the long end of the Indian bond market, bond market, will do a lot of the signaling for equity investors.
Sean, India has fallen a lot less than other emerging markets, and definitely a lot more less than developed markets like the US. What's your year-end Sensex target?
Well, I just follow my colleagues, and we tend to more look at India in the respect of a global asset allocation. We did note late last year that valuations had become a little bit stretched as inflation pressures emerged, but as I said earlier, that's no different from anywhere else. We have a modestly bullish rating on the Sensex within our global asset allocation. The two things that I would say mitigation for India at the moment, and that is it's going to have the best nominal GDP, which generally means a great nominal profit boom amongst global markets. So the top line story for India is probably the best of all the equity markets that we look at. And secondly, I don't feel that the currency is going to make a big depreciation. The balance of payment trends in India are actually okay outside of oil. Remittances are holding up well. There's been strong orders for US software and IT over the last quarter, which bodes well for the sector here. So in some respects, the pain and the punishment is being taken in bond market moves rather than in other sort of areas such as top line growth or a severely weakening currency.
Sean Darby, great to have you on the show today, and enjoy your gastro tour when in New Delhi.
Thank you very much.
Thanks.
Thank you.
Bye.